Hi, I'm John Ledesma, founder of Elevare Advisors and your host for today's webinar, The 4 Things Every Advisor Needs to Know About Succession Planning. I want to welcome you and thank you for taking time to listen in. Before we get started with the webinar, I want to ask you 4 questions. 1, are you a business owner-minded financial advisor? 2, would you like to build an enduring business that will last well beyond your career? And 3, do you see your practice as an asset that has value? And would you like to maximize the value of that asset before you retire? And 4, are you prepared to answer the question when asked by a client, what happens to me if something happens to you? If you answered yes to the first 3 questions and no to the last, then this webinar is definitely for you. Over the next 45 minutes, you're going to gain some very valuable and insightful information that will change how you see succession planning. You'll see that succession planning is way more than just finding a buyer to sell your practice to. I would encourage you to listen all the way to the very end. There, I'll give you an opportunity to have a no-cost consultation with me that will put you on the path to succession success. I will also give you access to a very important and timely white paper that will give you a whole new perspective on succession planning. So with that, let's get the webinar started. Hi, I'm John Ledesma, founder and CEO of Elevare Advisors, and your host for today's webinar. We're going to be talking about 4 things every advisor needs to know about succession planning. I'm very excited to have with me here today Scott Leak. Scott is a senior consultant with FP Transitions. Scott, welcome. Thanks for being here today. Can you share with the folks just a little bit more about you and FP Transitions?
Yeah, thanks, John. Happy to be here. So FP Transitions was founded coincidentally the same year I started in the industry, 1999. We are based in Lake Oswego, just outside of Portland, Oregon, about 65 employees, and we really specialize in helping advisors in all realms of the M&A space, and continuity planning, exit planning, succession planning, mergers and acquisitions. We do a lot of work on valuations. We actually do about 1,000 valuations a year, do about 100 M&A deals a year. So anything related to those topics, we have kind of the dual expertise of knowing both the M&A landscape as well as the highly regulated industry in which we all work in financial services. And then I personally have been with FP for about 3 years now. I spent 22 years at TD Ameritrade working with independent RIAs through the custody solution that TD Ameritrade provided.
Very good. Thank you. Well, I've personally had some great experiences with FP Transitions. They've helped me with some practice valuations, a couple over the last couple years, and I've recently had the opportunity to visit the home office there in Lake Oswego, and I came away very impressed with the folks that I had an opportunity to meet there. It's a world-class organization. So, again, happy to have you here with me, Scott. Thank you, and we're going to get right into it here. So we are going to focus in on 4 things today, Scott. We're going to get into the basics of succession planning and talk about that. We're going to learn how succession planning can be a tool to help protect your practice. And then we're going to get into a conversation about how to increase the value of your practice or firm by leveraging succession planning. I think this is a topic that most people would say wouldn't relate to succession planning, but it can be a great tool to increase the value. So I can't wait to get into more detail on that. And then we're going to wind it up and talk a little bit about plan design and implementation. So Scott, does that sound good to you?
Sounds great. Let's do it.
All right, let's do it. Like I said, we're going to start off by talking about the basics of succession planning. So I think a lot of advisors think about succession planning as a way to take care of what I call the 3 big what ifs. What if I retire? What if I die? Or what if I become disabled? And I think most advisors would agree that it's very important to have a plan in place if something were to happen to you, to make sure that those clients are going to be okay. Right? But I know that succession planning goes much deeper than that. So let's talk about that. How would you define succession planning? What is it? What is it not?
Great question. And I'm glad we're kind of starting off with getting the vocabulary right, because a lot of times people use the terms of continuity planning and succession planning interchangeably, or even to mean the same thing. So when we think of continuity planning, for example, we're talking more about what is the emergency plan in the event of death or disability. Uh, Succession, on the other hand, is much more intentional about a gradual transition of ownership of the business over time, from one generation, usually the founder, to the next generation of employees within a practice. So that's the primary difference. And I think for a lot of advisors, there's some hesitancy to do succession planning, for a variety of reasons. Some of them good, some of them make believe. But
Hmm.
for the most part, it's a difficult topic to bring up, much like it is when advisors are dealing with their clients talking about term life insurance and estate planning.
Sure,
Like you're talking about mortality a little bit. And
sure.
so it's a difficult thing. And a lot of advisors want to die with their boots on, so to speak. And so the idea of putting together a succession plan and transitioning ownership. And then there's the financial aspects of, like, why do I want to give up any of my profit distributions to somebody else when I want to keep working for 10 more years? And there's good
Yeah,
answers to all
exactly.
those. So I'm sure we'll get into the more as we progress today.
Sure. So, that brings up an interesting topic, Scott. So why do you think it is that financial advisors have such a hard time with the concept of succession planning? I mean, is it just the fear of letting go? Something that they've worked maybe 20, 30, 40 years on, and they think of it, this is my baby. I don't want to let it go. Do you think it's I haven't found a worthy successor, or getting the succession planning done, the process of succession planning? Is it just one of those things that's kind of difficult, so we tend to push it off to the back burner? What are your thoughts on that?
D, all of the above.
Okay.
So
All
yeah,
right.
those are all valid reasons that we hear, or reasons given, that we hear. The fear of letting go, for example, certainly something that we see. But when you look at succession plans that have been executed successfully, the letting go often ends up being a relief in many cases.
Yeah.
And it's because we're doing this gradually. That's a really key term here. This is a gradual transition of
Mm,
ownership and the ownership responsibilities. And if you
okay.
think about why most advisors got started in this business in the first place, it wasn't that they decided one day, I want to be a business owner. I'm going to
Sure.
select this career as the way in which I'm going to be a business owner. It's the other way around. They choose this career for one reason or another, decide I'm going to do this better if I go out and do it on my own, and I run my own shop. So for those advisors, because running a business wasn't the first goal and the first priority,
Hmm. Hmm.
sometimes that letting go can be a really positive thing, because there's a lot of junk associated with running a business that some
Hmm.
people don't like doing. It wasn't part of why they wanted to do it in the first place. Things like HR, compliance, choosing all the technology suites. There's so many different things that, you know, you have to do in addition to being a good advisor to be a good business owner. And if you bring in a partner, sometimes you can find someone that has some skill sets that you don't have and can take some of those things off your plate,
Sure.
that even if they might not necessarily want to do those things, a second generation partner is going to have to choose to do some of those things, or they're not going to get a stake at the table in the first place. So it's a great
Right.
way to offload some of the things you don't like. So I think that fear of letting go is a little bit unfounded, and they don't
Hmm.
realize that this can be a good thing, not a bad thing. Now, if you don't have a worthy successor, that's probably the best reason not to have a formal succession plan in place. And there's a
Okay.
lot of other solutions for that. Some of them being, you join up with a larger organization that might have the infrastructure, the capabilities to take those things off your plate, to free up capacity to help you go back to doing what you love to do the most, being a wealth manager for your clients. And then, over time, maybe because of that larger organization, you find someone becomes your right hand, and you can do something internally, or you just ultimately sell to that larger organization that you become a part of. There are solutions to that too, but that's probably the most common one we hear, and one that is getting harder and harder because of this battle for talent that we have going on in our industry as well.
Interesting.
That third one you mentioned, though, the process being too difficult, I think that's a little bit of a myth. And it's just probably a lack of education. So I thank you for putting together this webinar to talk about this,
Yeah,
to debunk this myth that this is something that's difficult to do, because with the right partners, this can actually be a fairly seamless and really eye-opening and enlightening experience that can make the business better. So it's not something that I would deem all that difficult, but it certainly is something you want to get right, and you need to find
sure.
the right partners to help you do that.
Sure. And I would say maybe as opposed to 10, 15 years ago or so, there are so many more resources available today
Oh,
to
yeah,
advisors to get a little bit of that hand holding. Would you agree? Like with your firm, FP Transitions, or even here at Elevare, there are things that we
right.
do working with our advisors to help them through the process. So it's really not an excuse anymore to say, well, where do I get started? There's plenty of resources out there, right? Yeah,
Yeah, I mean, the landscape has changed so drastically in the last 25 years. I mean, and even after FP Transitions got founded, our founder, David Grau Sr., literally wrote the book that's actually over my shoulder here on succession planning for financial advisors. And he wrote that book just less than 10 years ago. So
mm,
there wasn't even a good blueprint in the industry
right.
until the last decade. And then if you think about, organizations like Elevare, I mean, we didn't have an RAA that hit 100 billion in AUM until the last 10, 20 years.
That's
And now
right.
all of a sudden we've got, dozens of them that are over 100 billion, and we're on our way to having our first $1 trillion RAA probably in the
Wow.
next 10 years.
Wow.
So we're certainly seeing the trend. I think it was in 2019 that assets at the wirehouses actually fell below the assets that are at RAAs.
Absolutely. You mentioned something a little bit ago. You mentioned the difference between succession planning and continuity planning. Let's get into that for a minute. So, can you get into a little bit about the differences between the two and why both are important to have?
Yeah, continuity planning, if there's anything anyone takes away from today, this is probably the thing I'm most evangelical about. I believe that a continuity plan is a essential component that every single independent advisor needs to have in place.
I
And
agree.
and let me elaborate on that a little bit. If you were to go, if you pretend you're a consumer and you want to go hire an advisor, you walk into a Merrill Lynch office, you will have a Merrill Lynch advisor for life. You don't have to
Hmm.
worry about what happens to your Merrill Lynch advisor. You will always have a Merrill Lynch advisor.
Hmm.
Now, if you go hire an independent advisor, that might not be the same case. And case in point, like I hired my first advisor in 2014. I'm still with that advisor, but I don't know why I said my first. And I did not choose my parents' advisor
Interesting.
because it was a one-man shop, and I
Hmm.
realized that that person who is a good advisor for my parents is probably not going to be around when I retire. And there's no clear path as to who's going to be there in that business. I don't believe
Hmm.
that business will be there in 30 years. So that was a good reason for me to go out and find an organization where I knew I
Yeah.
wasn't going to have to find another advisor again. So if my parents' advisor, for example, had said to them, I have a continuity plan in place. If anything happens to me, this is what's going to happen to you. I might have had a little bit more confidence in working with that advisor myself. And
Sure.
so
Sure.
just having anything that says, in the event of my death or disability, this is what's going to happen to my staff if I have any employees, like who's going to write their payroll check the day after I pass away, what's
Mm.
going to happen to those clients, and what's going to happen to my family. The continuity plan should spell all those answers out.
Yeah.
You're usually picking someone who is going to be either a guardian of the business for a period of time until the business can be sold, and that person might help the estate find an appropriate buyer. Maybe they can just keep taking care of the clients until that time comes. Oftentimes, that person who's willing to do that is often willing to buy the business as well, and you come up with what are the terms and conditions of that transaction ahead of
Sure.
time, because you're not going to be around if a triggering event occurs for death or disability. You're not there to make those negotiations happen anymore. So
Right.
that's really the difference with continuity planning. Whereas succession, it's someone that's working with your organization that does the same thing you do, that they are usually an advisor themselves, and they're in a position to gain an equity stake in the company. And maybe it's just 10% of the business, You see how that goes after the first tranche of sale, maybe do another 10% or 20%. And over time, that person or persons, I'd even recommend having a succession team. We usually recommend two G2s for each G1, second generation versus first generation. In case anything happens to one of your two G2s, maybe they decide they don't want to do it. Maybe you decide they're not a good partner. Maybe your business has gotten to be so valuable that it's too expensive for just one person to buy out on their own. So a
Mhm.
succession planning team of multiple people would be ideal. But that takes a lot more time, a lot more planning, and the actual execution and implementation of it can take 10 to 20 years. And so we
Sure,
recommend people start doing
sure.
succession planning maybe around age 50 or about 20 years before you plan to retire. Continuity planning, on the other hand, should happen the day you open your doors.
That's interesting, Scott, and I appreciate you talking about that. So, just because you have a continuity plan in place with somebody doesn't mean that that person is going to be your successor. It just means that you've planned for your clients to be taken care of in the event that something were to happen to you, and it happens. It happens
That's
all the time. Let's go to kind of the dark side of this. Let's say that an advisor has neither a succession plan nor a continuity plan in place, right? What's the default plan? I've got some thoughts on that, but I'm going to let you go first.
so there's kind of this spectrum of protection, if you will. And on the far end of no protection, you don't have any type of plan in place whatsoever. The next
Hmm.
step would be you find somebody and you have a verbal agreement with them. That's not really a plan if it's not written, it's not executable, it's not enforceable. So that's really kind of the bare minimum to have in place next. Then I would say to have some type of guardian agreement where you have something in writing, like I said, someone that can take care of the clients, take care of the business. It can be someone within your own organization. Maybe it's your director of operations, or someone who you trust that can continue to keep the business afloat long enough that there's not client attrition. It could be somebody that you know across the street. It could be a competitor that you're not necessarily viewing truly as a competitor, but it's someone who does the same thing you do, but just with another
Sure.
organization. If you're with a broker dealer, it would be ideal to find someone that's within that same broker dealer,
Yep.
but it's not a requirement that be the case. But implementation wise, it gets to
Sure.
be a little bit easier. But then on that far end, the best continuity plan is, again, having a full blown succession plan, having another partner in the
Yep.
business where if you're owning an LLC, we have written, assuming you had FP transitions do the work, we will write into the corporate governance documents what are all these terms and conditions? What are all those contingencies that could possibly happen where if anything happens to one of the two owners or three owners, what happens? How do the other ones buy them out? What are the processes for that? So that's
Yep.
kind of the spectrum of least to most protected. There is kind of what we call a practice emergency plan, where we do help advisors just say, I have it written down that in the event anything happens to me, my estate is going to contact FP, ask FP to put it out for sale on the open market as quickly as possible, and try to get the most highest dollar we can for the best fit for the clients, and the estate still gets paid, the clients still get taken care
Sure.
of. So at least if you have that in writing and we're ready to go, we can usually get better price on that than if someone just comes to us out of the blue. We didn't have anything planned,
Yeah.
didn't know anything about them.
Yeah. Great points. And I think a default plan can also be, for a firm like a broker dealer firm or an RIA firm, if they have an advisor that who's affiliated with them that either becomes incapacitated, can't run their practice, or
Yep.
they die, the default plan can be, we are going to make those accounts house accounts, or we're going to reassign those accounts to advisors. Neither of those scenarios are necessarily what's in the best interest of the client.
Right.
So the only one that wins there really is the firm. The
Correct.
client doesn't win, the advisor doesn't win, the advisor's family doesn't win. It's a horrible situation to put everybody into. I'm reminded of a
It's a
conversation that
gamble, and when you gamble, the house wins.
Absolutely. Yeah, that's a great way to put it. Um, I'm reminded of a conversation that I had with an advisor. This is going back about 4 years ago. But we were talking about our time in the business, and this particular gentleman has been in the business for about 30 years or so, has a great practice, has a lot of clients, drives great revenue. But somehow the conversation got turned into a conversation about succession planning. And I could tell he was getting a little bit fidgety, and he stopped the conversation. He said, John, he said, I don't believe in succession planning. He said, I've thought about it. He said, I don't believe in it. And I kind of scratched my head because I've never really heard an advisor say that before. And he said, let me tell you the deal. Here's the deal. He said, I'm going to do this till I can't do it anymore. And then when I can't do it anymore, my clients can figure it out. Now, that caught me by surprise, because I can just imagine if his clients were to know that, how that would make them feel. But then I also got to thinking about that conversation. I thought, well, for all the advisors out there who do not have a plan in place, um, they're basically saying the same thing to their client. They're just not audibly saying it. And I would also think that there's a lot of value once you have a plan in place, Scott, both succession plan and a continuity plan, to let your clients know about that plan. Would you agree? Let them know about
It's
it.
it's vital, and the amazing thing is our data shows that firms that communicate that grow. There
Hmm.
is a growth to be had from that because the clients can breathe a sigh of relief. They know what's
Sure.
going to happen. It opens up the doors for referrals. And particularly when you've got a succession plan in place, that is a drastic growth changer. So
Hmm.
when we
Hmm.
look at the data, so again, we do 1,000 valuations a year. We've got over 15,000, I think it's 16,000 now, firms that we've done valuations for. So we've got a massive database that we can look at and draw certain trends. And one of the most obvious ones to me when I got here was the growth rate of net new clients of single owner firms versus multi-owner firms. So when you bring in someone else into ownership, you bring in that successor, that G2, they become an owner. They are taking on a massive amount of debt because they
Sure.
usually don't have the money to buy in for cash. So if you've got a business worth $5 million, someone's buying 10%. They're actually, the value is worth less than $500,000, but that's a discussion for another day. But let's just say, for the sake of argument, it's a simple math and it's worth $500,000 for them to buy 10%. A 35-year-old, 40-year-old most likely doesn't have $500,000 laying around to invest. So they're going to have to take out
Yeah.
a note, either seller financed or bank financed. And the way they're going to pay that off is they're now getting 10% of the profit distributions of the company.
Mm-hmm.
How do they pay off that note faster? By larger profit distributions. How do you get larger profit distributions? That G2 goes out and they bust their butt even harder now
Sure.
because they care more about the profit distributions than ever before.
Yeah.
So we see this surge of activity, and it is with, generally speaking, very valuable clients, because a
Hmm.
G2 is more likely to attract people that are around their age. They're going to bring in people who are in their peak accumulating years rather than the G1, who might be having a
Yeah.
lot of clients who are in their peak
Yeah.
declining years in terms of
Yeah.
the value that they're bringing. Meanwhile, because they've offloaded some of those ownership responsibilities we talked about earlier, those G1s now have freed up capacity. They're seeing the G2 start to really crush it and going out and bringing in new business. They're feeling competitive. They've got the capacity now. They go out. It's what we call the rejuvenation effect. So those
Mm.
G1s go out and start bringing in new business. So you're seeing a difference of growth rates of around 12% for a single owner versus 22% for a multi-owner firm. So again, for the advisor that's saying like, well, this doesn't make sense for me financially, I would push back and say, would you rather own 12% growth and own 100% of it, or own 80 to 90% of a company growing at 22%? The math is
Right.
pretty easy on that.
Yeah, absolutely. So when should an advisor start the succession planning process? You hear numbers thrown around out there. You hear 1 year, 5 years. Um, you work with advisors all the time. You have these conversations all the time. You've seen the data. When is it really ideal to put a succession plan in place?
10 to 20 years or age 50 is the kind
Yeah.
of textbook answer as to when is the ideal time to start. But I mentioned earlier, think with the or plan with the end in mind. And what I mean by that in this case is, when you want to maybe start working 30 hours a week or less, you need to have already transitioned ownership by that point. So that might be a
Okay.
helpful way as you think about, when do I need to work my way backwards from that point? Not necessarily when do I want to be completely done, because very few advisors want to go from working 50, 60 hours a week, if you're lucky 40, down to zero just
Yeah.
one day.
Yeah. Not going to
So
happen.
this opportunity that succession planning provides is for what we call a glide path to retirement. But once you hit that point where you slowly are gliding towards retirement and you say, I've reached a point where I have, built this business. I want to enjoy the fruits of my labor. I want to take Fridays off. I want to take July off, whatever it may be. Once you cross that 30-hour week threshold and you've got employees who are doing a lot more work than you're doing and they're not getting
Mhm.
any of the profit distributions, you might have a coup on your hands. So
Yeah.
that's the time where if you haven't started to transition at least your first tranche by then, you're a little bit behind the eight ball. And
Yeah.
again, not that there's not solutions for it, but the sooner you start, the more options you have.
Sure. And I heard you mention 20 years. I think that is a concept that most advisors really haven't thought about. You alluded to it. Now I want to have a conversation about um, how is succession planning being used as a tool to protect a practice or a firm, maybe when it's at its most vulnerable time.
So we've seen some really interesting legislations in our we've got about 10 attorneys on staff here at FP, and our general counsel just wrote a blog that came out last week that talked about this a little bit. And I think it's a topic that we're going to hear more and more about. But California has become kind of anti non-competes. They have put restrictions on them
Yeah.
and basically said they're more or less null and void. And a couple other states, I believe Illinois and Delaware, have also passed similar measures. Massachusetts is talking about it. The Department of Labor is talking about it as well. So I
Hmm.
think we're going to see more of this, and it is going to be challenging for advisors to have employees, particularly if they're staying within kind of an eat what you kill model, and each advisor owns their silo, their book of business. What's to stop them from going across the street, taking their clients with them? What's to stop them from taking all clients with them
Yeah.
that they
Yeah.
that they could reach out to? There is something that can prevent that from happening, though.
Okay.
Non-competes apply to employer employee. But what if you are the employer?
Hmm.
So if you bring someone in via succession planning into ownership, they are now the employer as well. The non-compete is valid. So between two partners, you can have non-competes. You can
Okay.
say that you cannot, as an owner of this organization, you cannot go out and compete. An employee can. So succession planning can now be a more powerful tool than ever to help protect the business, because those employees that could go out and start their own business now are owners and partners in this firm, and that non-compete can still be valid. So that, I think, can be a really important way to do it. But again, if you want to attract talent, having an equity pathway in place
I
that
agree.
says, if you come here, this is what your future can look like here.
Mhm.
That is going to be a big motivator. We need to think about, as an industry collectively, independent advisors need to address this issue of how are we going to attract and retain next generation talent. Succession planning
Yeah.
is the top way to do so.
Sure. So let's say I'm a 55-year-old advisor. I've got a junior advisor, maybe two, that works with me in my practice. I've got a successful practice, but I'm kind of getting to that stage in life where I'm slowing down a little bit. I haven't locked either of my junior advisors or G2s into any kind of ownership. And you just mentioned a little bit ago that firms out there are getting attracting new advisors is a very competitive space right now. So writing these big checks and so one of those two juniors now leaves my firm, joins another firm, or goes to another broker dealer or RIA. They've had an opportunity to get to know my clients. There's no non-compete clause really in place, especially here in the state of California, that's going to keep them from calling on my clients. That could be a problem, right? That could
Be
be
a
a
very big
problem.
problem. It could devastate the enterprise value you've spent so many years
That's
building.
right.
Yeah,
And now the value of my practice, because assets are leaving, is now starting to go down. But the way to maybe alleviate all that is to bring some ownership in play, or at least a path to ownership. Did I hear
I
that
think
correctly?
that was a really important distinction. At least a path, I think,
Hmm.
is something that needs to be communicated. I am not going to advocate that you bring someone in the organization and give them equity year one. I
Hmm.
think you need 2, maybe even up to 5 years of dating, of getting to know each
Hmm.
other,
Sure,
and determining,
absolutely.
like, are we culturally aligned? Are we
Hmm.
philosophically, investment philosophy aligned? Are we, do we both agree that we need to lead with planning versus whatever it is. All of those things need to be figured out. And like, do we like working together? And
Hmm.
do we both want to do this transition? And sometimes G2s don't necessarily want equity. The ones that want it are going to eventually get antsy if they're not offered it.
Sure,
And
sure,
so have a
sure.
discussion with them early on and just to say, is this something you'd even want? Would you be interested in
Yeah,
this? You both are going to benefit from having an honest
sure.
dialogue. And then if they are interested, now the timer starts and you only have a certain amount of time before they're going to lose patience. I think 5 years is about the maximum you should go before offering them equity if they're interested, willing, and show the will and the skill to do it. And once that happens, then you need to go to another 2 to 5 years of them paying off that note, showing that they can step up, showing that they're taking on ownership responsibilities, producing more revenue. Like those are some things that you should see. And every firm needs to decide for themselves, what does it mean to be an owner here?
Hmm.
That answer can be
Yeah,
different everywhere. And you
sure,
need to
sure.
decide, what does it mean to be an owner here? And everyone needs to agree. And whatever those standards are, how are they doing in regards to those standards? And sometimes the G2 is going to say, I don't really like this. I'd rather just go
Hmm.
back to being an advisor. And others are going to
Yeah,
say, this is amazing. I want to keep going.
yeah, yeah.
So yeah, this is why I said 10 to 20 years, because if you think about it, if you go on the longer end of those two spectrums of up to 5 years to get to know each other before you give equity, and then maybe 5 years before they buy their second tranche, you're talking 10 years before
Sure.
you've sold more than 10 or 20% of the company. So if you
Right.
were thinking about how long is it going to take you to sell all of it, you need to
Yeah.
plan for this again,
Yeah.
minimum 10 to 20 years ahead of time,
Yeah,
ideally.
yeah, that's a very worthy conversation. And I don't think many advisors think about succession planning as a way to protect their business, but it absolutely is. Let's talk about how to increase the value of your firm via succession planning. How is succession planning used to increase the value of a practice?
So yeah, and yeah, we kind of talked about this a little bit in terms of just the obvious thing, which is the growth numbers. The data supports that multi-owner firms grow faster than single owner firms. If you also look at what we're seeing in the M&A market space, the most common type of transaction that we see right now is not what it was 10 or 15 years ago. It used to be that when an advisor wanted to sell their business, it was sell and walk away. Like within 12
Hmm.
months after
Hmm.
the sale of
Hmm.
the business, they're on the beach. But what we're seeing now, it's probably 70% of the deals that we do is what we call a sell and stay. I think a lot of advisors fear this because they think, well, if I sell, now I'm an employee again. I don't get to call the shots anymore. And that's not why I went independent. But if you find the right like-minded partner, it's not going to feel like you're giving anything up. And so
Hmm.
what we're seeing with the advisors who are on the buy side of those sell and stays,
Hmm.
they are far more interested in buying practices, not with a 60-year-old with no succession plan. It's with the 60-year-old that has a succession plan. They want that younger next generation talent because they're struggling with it too.
Sure.
So they are paying more and more interested in firms that have that second generation already in place
Mm.
because they know they're going to have better retention of those clients, not just when this transition happens, but when the next transition happens, when that 60-year-old passes away or
Mm.
retires or whatever, that 40-year-old or 45-year-old that's the G2 is there and the clients already know that person. So they have already got a multi-generational asset that they've just purchased. So for firms that do succession planning, it's not even necessarily, and that's the example I gave of that 70-year-old who wanted to be out in 2.5 years. The solution in a case like that is you bring your G2 and you get them some ownership, you sell to another organization, then shortly thereafter, that G2 now swaps their equity that they got in firm A with firm B that bought them. And they're now an owner in a larger organization that probably is growing even faster than the first company was anyway. So now
Yeah.
that person is incentivized, like they're feeling good about it too. Like everybody wins in this scenario.
Yeah.
And
Yeah.
so, you think about, your clients when you sell to that larger organization eventually, Clients are likely getting services that you don't necessarily offer because the firm just has more capacity, more centralized operations. They've kind of built a better mousetrap. They might have attorneys and CPAs and all kinds of other people on staff that can help with things that in a smaller practice might not happen. But you can still, if you've got that G2 in place, you can still preserve that boutique feel that maybe is really important to you and your clients as well. And so they have that continuity. So again, bringing that successor in just about any scenario is going to make that business more attractive from a valuation standpoint to any third-party buyer, but certainly to that G2. And again, those G2s, it's now on them to find the G3s and bring in that next generation. They're going to want to build up the asset quickly too, because they're eventually going to sell their shares to somebody else.
Sure. Well, let's talk about the growth trajectory of a single owner firm as opposed to a multiple owner firm. What do those numbers look like?
So when you look at the data on the growth rates of advisors by decade of their own lives, advisors in their 30s tend to grow at a pretty good clip, 40s even better. In their 50s is usually the peak. So your highest growth rate as a single owner, single operator, you're having your highest growth rates in your 50s. It declines a little bit in the 60s, and then it drops dramatically in their 70s, to the point where if the markets are good, it's probably masking the fact that the business is actually declining in terms of net new clients. And so in a down market, that could look really, really bad, or even in a flat market, it can be bad. I mean, fortunately for all of us, 3 out of every 4 years the market goes up. So it does mask these potential issues. But when you look at the growth rate by age of advisor, when you bring in, if you're 70 and you bring in a 50-year-old, you're now getting that 50-year-old growth again. Now, after a certain point in time, those clients become less valuable because they're taking out their RMDs, they're making withdrawals to buy, college for grandkids or whatever they're doing, and they're depleting their portfolio potentially faster than the market is increasing it. And so you get to a point where if you've got a book of business and the average client is, let's say, 80 years old, as a buyer, do you want to buy that business?
No.
So the value is going to go down as the client base increases, and you bring in the younger advisor, it helps drop the average age of the client of the book of business. So that's going to help increase the value of the book as well.
When you compare the growth trajectory of a single owner firm to a multiple owner firm, would you say that single owner firm is probably less than 10% in terms of growth, and maybe a multiple owner firm you can get into double digits, maybe 20+% growth?
Yeah, so the best measure of this in my mind is measuring net new clients rather than revenue growth, because the revenue growth can be again masked by the markets. The way to take that out is just to look at how many new clients or how many new assets net new, so you take the withdrawals and the deposits and you reconcile them, and that's your net new client growth rate. So if you're looking at that number, single owner firms, and I didn't look at this here in 2024, but last year the number was around 11.8, 11.9% growth rate net new clients on average. Multi-owner firms was closer to about 21.8. So almost double the
That's
growth
interesting.
rate on multi-owner firms. So it's a pretty significant difference when you've got two people going in, bringing in assets rather than one.
I love it. Let's transition into a conversation, Scott, about plan design and implementation. All right. So what are your thoughts on that? Where do you get started? What's the process? Can you go into that a little bit?
Absolutely. It's really helpful to know, if you're thinking about doing any type of transaction, what is the value of what you're going to transact on. So evaluation is usually where we start, and we tell advisors that what What drives valuation methodology is the purpose in which you want to do the valuation. So let me elaborate on that.
Okay.
There are market-based approaches to valuations. You can do an asset-based approach. You can do an income-based approach. Now, we're not in an industry like manufacturing where an asset-based approach makes sense because you don't own, machines and widgets and all these other things that you're measuring all these hard assets. So a market-based approach or an income approach are the two methodologies we see most often in our industry. The
Okay.
market-based approach to valuation is going to look at, if I were to sell this business on the open market, what is the most probable selling price under average deal terms?
Okay.
And help me remember to come back to talking about average deal terms and what that means for multiples. But finishing on this thought, so a market-based approach is really helpful when someone wants to figure out, if I were to sell my business, what's it worth? And even if you're not thinking of necessarily selling it today, it's a good benchmark to know this is where I'm at. And if, let's say, my business is worth 3 million, and I know for my own retirement planning needs, I want to hit 6 million. Okay, I know where I'm at now and where I need to get to. And so what things do I need to do to get to that, to my number, if you will? Now, the income-based approach to valuation is going to do much more in-depth work. It's still going to help you figure out what's the most probable selling price, but it's going to look at a discounted cash flow analysis is usually how that's done. And it's going to look at, what is this business probably worth in 10 years as well?
Okay.
Does it make sense to invest in this business versus any other business? So if you think about what someone's doing, whether it's a successor or a buyer out in the open market, what the analysis that needs to be done is no different than it needs to be done if you're determining whether I should buy stock in Tesla or Ford. The only difference is it's a public company versus a private company, but the fundamentals are the same in terms of determining, is this a good value? So you're going to want to look at things like, what is the profit margin of the business, and what is the growth potential of the business? You don't really care what past earnings were, you care about what future earnings are. So a discounted cash flow is going to help you do that. That is really, really important for that successor. The successor doesn't care so much about what is this business worth today. It's, what is this business going to be worth in 10 years when I own 10%, 20%, 50% of this business. And so we're able to do those types of calculations, and we can calculate, what is a minority stake in the business worth? Because you're buying an illiquid position and a non-controlling interest, it is not the same as, like I mentioned in that example earlier, of a $5 million business selling 10%. It is worth less than $500,000 because of those two factors. So we can calculate, using that type of approach, that methodology, what is that minority stake worth, whether it's 10%, 12.5%, 17%, whatever it is, we can calculate what's that minority stake worth. So it's very important to start with just doing the right valuation and knowing, if I were to have a transaction, whether it's on the open market, selling to a larger advisor that or selling to a G2, what's the business worth? So after the valuation's done, then it usually makes sense to do some detailed analytics and do some financial modeling, economic forecasting. So we at FP have a team of analysts. We've got some CFAs on staff. We'll do like a 10-year pro forma and model this out for G1 and G2. The G2 is looking at this saying, hey, this is a lot of money. I got to get the spouse on board with this too. And this is going to be a tough pill to swallow, another giant loan. So we need to show them, hey, this isn't actually going to be that bad, because you're going to get those profit distributions. We can figure out and map out a model whereby, let's say the profit distributions come in, we want to make sure you're putting a little bit in your pocket. So like, you should be getting some reward. You shouldn't take all of the profit distribution to pay off the note. So how do we calculate, how do we get a little bit in that person's pocket, and how do we get enough that goes to pay off that note, so we can figure out, should that note even be a 3-year note, a 5-year note, a 7-year note? How long does it need to be? How long is it going to take to pay it off? And then what are all these what if scenarios? What if growth rates go faster? What if they slow down? And how does that affect profit distributions? What if we do some things to improve expenses? What if we do things to improve revenue? And the G1 needs to know the answers to all this too. They need to know, what is the financial impact to them of doing this, because they might have to decide, do I want to do seller financing, or I'm going to make them go get bank financing? So there's a lot of things that get figured out in that analytics phase, and we're often doing all these different scenarios. Sometimes advisors come to us and go, I don't even know, do I sell them 10%? Do I sell them 15%? What's the right amount? We can model out all these different scenarios and figure out what makes sense for each of you, and then map out, what should tranche 2 look like, tranche 3. It never works out exactly how you mean for it to. Just like you probably don't have a client that walks into your office at age 40 and their retirement plan at age 70 is exactly how they planned it at age 40. You have
Never.
these what if
Yeah, yeah.
scenarios, and that's why you do
Sure,
Monte
sure.
Carlo simulations and
That's right.
everything. But you plan for the course corrections and you leave some wiggle room, but you map it out the best you can. And then we hand it over to our attorneys that need to do all the legal documentation to make this official. So the implementation of this is going to involve writing an asset purchase agreement, for example, making sure that there's those restrictive covenants in place for this person who's now an owner, rewriting all the corporate governance documents and figuring out like, okay, we are partners now. If we own an LLC or, if it's an S Corp, we do things with that too, but we need to rewrite the corporate governance documents, the member agreement, the operating agreement, and figure out what are all the rules of engagement. We're kind of like writing the constitution, if you will, for this entity. And what does it mean if anything happens to one of us?
You told me to take you back to average deal methods, or I
Yeah.
forget what the
So
exact terminology was. So where did you
yeah.
want to go with
So
that?
people always want to know, like, well, what are average multiples right now?
Hmm.
Uh, when we talk about what the value of a business is, when we do that market-based approach to valuation, we say we believe this is what the business is worth. We might say we believe this business is worth $5.47 million under average deal terms. That business could be worth 4 million. It could be worth 7 million, depending on what the deal terms are. Average deal terms is what we use to determine, and we've got all the data because we do 100 plus M&A transactions a year, so we can go, this is what average deal terms were last year, so we can accurately state that. But if someone wants to know what multiples are, the first thing that I ask is, well, what are the deal terms? And they go, well, I don't know what the deal terms are. I'm like, well, I can't tell you what the multiple is then. It's like saying,
Interesting.
like, if you want to go out, like, John, you could go into a Ford dealership there in California, and I could go to one here in Omaha, and we can both walk out with the same F-150. Your payment could be $750 a month. Mine could be $1,000. Did I get screwed? No, we had different deal terms.
Yeah, yeah.
So,
Okay.
the multiple is not the right question to even ask,
Gotcha.
because we need to know deal terms in order to be able to say, how much cash was down, if was it 40, 45% down, or was it 10? And the more cash down, the more risk there is on the buyer. The less cash down, the more risk there is on the seller. The longer the note goes, the more risk. So there's all these different factors that go into it. And so that's one of the things that when we're doing a market-based approach to valuation, we're just starting with that basic assumption of these are average deal terms, but as the deal terms change, the price changes, and therefore so does
Gotcha.
the multiples.
Yeah. So, can you touch on the how to structure a sale typically? So you have advisors out there who are okay. I'm ready to do the sale. Typically, do you see what are you seeing out there, Scott? I know there are some firms that where advisors are buying a practice simply on a promissory note. Others are putting money down. You'd rarely see a situation where the buying advisor is paying for the whole practice all at one time. So what are you seeing, Scott? And typically, how are those structures done?
Well, first of all, to just kind of keep with the succession planning theme, we are seeing probably more so in the last 5 years than we've ever seen before. Buyers are buying talent just as much as they're buying clients and the revenue.
Okay,
So to just put another a stamp on that, this note of succession planning is really important to lock in that talent, because we've got advisors that are out there buying businesses because of the talent, and that is valuable to them because that has the capacity to bring in more clients than the business even had in the
that's right.
first place.
That's right.
So that's a really key component to that. But in deal terms in general, yeah, we're seeing probably about 45% down payment is about average
Okay.
right around now. The
Okay.
rest of it is on maybe around a 3 to 5 year note. It used to be back in the day, particularly with broker dealers, that you might see things that would have revenue sharing and all these different components to it. Even earnouts are kind of on a decline, and more often than not, we're just seeing somebody say, "Look, let's just put in a clawback provision that says that after a year, if we've got, let's call it 90%." Of the clients or the revenue or the AUM, however you want to measure it. If 90% or more is there, we're good. If it falls below 90, we're going to have a dollar for dollar reduction though. So for example, if a year later, the agreement said if it falls below 90%, we're going to reduce each percentage accordingly. So if there was 88% of the revenue retained and 12% attrition, that whatever is left on the note gets reduced by 12% of the entire
Gotcha.
original
Okay.
value.
Okay. Good. Good. Well, Scott, thank you. This has been a lot of fun.
Yeah, likewise.
We've covered a lot of subject matter today. We've talked about the basics. We've talked about how to use succession planning as a tool to protect your practice. We've talked about increasing the value of your practice, and we've gotten into some plan design and implementation. A lot of value in there, and I appreciate you joining me on this webinar today. You've got a lot of knowledge in there, so thanks for sharing it with us. Um, should the folks out there want to connect with you or FP Transition, Scott, how would they go about doing that?
Yeah, I mean, we can be found very easily at fptransitions.com. That's FP as in financial planning, transitions.com. So you can go to the website, you can read up on all the different services that we have to offer. There's also usually a button on just about every page that says talk to us or schedule a consult. And you can see the calendar and book a meeting to have a free consult with anyone on my team, whether you want to talk about valuation, continuity planning, succession planning. We help firms with compensation design, anything related to helping advisors identify, build, or realize the value of their business. We're there to help.
All right, my man. Well, thank you very
Awesome.
much, Scott. We'll be in touch.
Bye.
Bye. Hi, and welcome back. Thank you for taking time to listen to our webinar today, The 4 Things Every Advisor Needs to Know About Succession Planning. I hope the last 45 minutes have made a profound impact on how you see succession planning. Now you know succession planning is not about slowing down and walking away. It's about a smooth transition of your business and practice to the next generation advisor. It's about growth. It's about protecting your business. It's about peace of mind. So what's next? Now's the time to start your succession journey. And the best advice I can give you is don't go it alone. I would encourage you to take advantage of a confidential, no-cost consultation with me. During our collaborative discussion, we'll take a 4-point approach. Number 1, we'll examine your current situation. Are you a sole practitioner? Are you part of a team? Are you part of a partnership? We'll discuss any resources you have available to you, if any, to help you through the succession planning process. And 2, we'll talk about what an ideal succession strategy could look like for you. Do you see yourself exiting over a short time period? Or do you see your exit years down the road? Do you want to sell your practice but stay in the business and still earn an income? And next, we'll talk strategy. We'll discuss the different succession models and what an ideal fit could look like for you, given your unique circumstances. There is no one-size-fits-all when it comes to succession planning. And lastly, we'll talk about how to implement your succession plan. You know, there's no doubt without a formalized succession and continuity plan, you're putting everything at risk. Without a plan, you, your team, your family, and your clients could all suffer as a result. So here's the big question, knowing what you know now. Are you ready to do something about it?